I'd like to introduce myself. My name is Doug and I'm from Introtocryptos.ca. Now here again is the disclaimer. We've already taken a look at it, so I'll slide past and get into the good stuff. I imagine you agree with me that technical analysis and chart reading is one of the most important tools for every crypto trader. And the reason you're here is to take your skill another step towards becoming pilot level expertise. Or maybe you've been frustrated with your trading results and you're here seeking some answers. Perhaps one of the main reasons you are over trading or losing money or just struggling to be profitable is because you don't have the complete plan that you understand from start to finish. Once you understand the plan from start to finish and you believe in it, it's much easier to follow all of your own trading rules. You may be letting losses grow too big. Maybe you're taking profits too quickly. Having an understanding of the complete system will help you be more selective and more confident in the trades that you take and the trades that you keep. And that's what we're going to cover in this video. We'll build a practical and complete trading approach, and we'll apply it through all the cycles of the trade. So be sure to watch right to the end of the video so you get all of the steps. You don't want to miss one of them because they all work together, and the entire plan will fail if you miss just one of these steps. So let's start off with some proof. Let me begin by showing you that the trading plan I'm about to teach you will work and that you can work it. Let's start off with this trade. This is ENJ coin on Binance. We published this pro alert back in February 20th. We update our spreadsheets daily, so our subscribers always have the list of markets that we see the most potential for matching our trading criteria. We provide specific entries, stop loss levels, and our profit levels for every single market that we're talking about. So in this example, we gave out the alert on February 20th, and you can see the chart pattern that we were looking for here. I'll explain more about that as we go along. The chart pattern and the exponential moving average crossed over to confirm our alert and turned it into a hold status. The hold status was downgraded to an exit for a profit of 308%. And this is based on the 5 stages of the trade that I'm going to show you today. Let's do a couple more examples. Here we have DLT. We can see that we prepared for this trade entry early in December of 2018 as the chart patterns were setting up the first stages. And here the alert status remained active in this market for about 3 weeks before the chart hit our target entry and we took action. The exit signal was then issued as prices threatened to drop below that 1, 2, 3 top formation, and I'll explain more about that. We locked in 147% gain from our target entry price. A third example is an alert that we issued for Steam in February of this year. This is a good example because not all trades blast off to fantastic gains. And the approach you learn today includes all of the important strategies for risk control to ensure you close bad trades and you close good trades and take your profits before they become bad trades. So one final example here is for RCN. At this time, the general crypto sphere was turning bullish, and we published our alerts in our pro package because we anticipated several great market entries here. As it turned out, the exit signal for RCN was provided as the top formation broke lower and the exponential moving average crossed over. That gives you a few examples of actually using this trading plan, and I'm going to share more of it with you today. We're going to build a tool set so that you have all the skills to identify these potential trade setups and be prepared to make money when the markets are ready to make money with. So now that we've reviewed some of the examples, let's dig into the 5 stages of the trade and the basis for learning technical analysis in a practical way for the complete beginner. Technical analysis always starts out with an understanding of chart patterns. This is the most important skill to learn. The key chart pattern for our technical analysis is the 1, 2, 3 top or bottom you can see here on the screen. It's really simple and it's incredibly powerful. The reason this chart pattern is so important is because it defines the beginning or the end of a trend. In other words, this one pattern creates the chart structure that gives us the ideal entry point to risk a trade, and later this same pattern also gives us the ideal point for taking profits and closing the trade. But you will learn more than just that pattern, because by the end of this presentation, you're going to have a practical way to look at the chart and apply our trading method at the right time. Why you need the big picture. When you see how all of these pieces work together, you will see the big picture from start to finish. And this is where your trading confidence comes from. This is where your patience comes from, so that you can reject the more risky trades and have the wisdom to select only the best trades. This is where your resolve comes from when you're in a trade, so you can stay in that profitable trade long enough to get the most out of it. But first, let's lay some of the groundwork. First, I'm going to introduce the simple trading plan. I'm going to explain the 3 elements of this powerful trend change approach, and then we'll review the preparation process required as you identify potential trading patterns. The simple trading plan. The simple trading plan has been distilled down from hundreds of hours of backtesting and years of forward testing in the cryptocurrency markets. I've had more than 2,000 students go through this course to help me correct, verify, and make this trading plan proven. Basically, there are 3 components to identifying a trade entry point. The first requirement is that the downtrend must be broken. The second requirement is that the 1, 2, 3 bottom formation must be breached, and I'll explain more about that shortly. And the third requirement for the trading signal is that the exponential moving average must cross over. So let me explain each so that you get that clear picture in your mind. Now, drawing a trend line is not difficult. You probably already know this. We connect a straight line from consecutive higher prices or consecutive lower prices. As the price is declining in a downtrend, we draw the trend along the tops. As the price is rising in an uptrend, we draw the trend line along the bottoms. Trend lines can be drawn any place there's 2 prices that stand out, but there's always more strength when they have more places that they touch along the path. Let's go into Bitcoin and we can start looking at trend lines. We can draw the trend line along the bottoms and see where that trend line was broken. We can draw this along the bottoms where we're watching to see the trend line to see if it's broken. We can draw trend lines along the highs to see when that downtrend line is broken. All right, let's jump back into the presentation. So now we can see our trend lines. Now the 1, 2, 3 formation takes a bit of explaining, and I'll show it to you, and you will see it in every chart that you look at after that. Now, if you're familiar with Elliott waves, you'll know that the 1, 2, 3 formation also occurs at the end of almost every trend. It is an important component of the head and shoulders formation. This formation also comes by many names. Some people call it the W formation, and really it's a simple failed retest of a recent higher low. Let's go take a look at a specific chart. So if I zoom in and just go to a weekly view, we can see that we have a downtrend using these lines right here. We can see that prices came down, and this is the lowest price of this little downtrend that we had. So we have the number 1 point here. It bounced up a little bit. Prices tried to come back down and break lower, but they failed. And as they broke above this, you can see that we now have a W here in the chart. This is the 1, 2, 3 bottom formation breaking higher right there. And this is what our trading signal base sets up to. So here we have a 1, 2, 3 top formation. As prices broke below this level, it's our sell level. We have another 1, 2, 3 formation here to verify a second sell in our top formation. And each of these trades we were publishing and putting out on our YouTube channel. So we can follow back on all of those and learn from them. So the 1, 2, 3 formation is extremely powerful. The next thing we add into this trading plan is the cross of the 60-20 exponential moving average. And it serves as a filter to filter out the sudden spiky moves that are so common in cryptocurrencies. And these may be caused by pump and dump groups. They can be caused by social media excitement or news release. Many short-term moves can be considered just waves coming up the beach and they slide right back. And this trading plan is intended to act when the tide is changing, not just when the waves are splashing up and down the beach. So once the direction changes, this trading plan picks it up. So that's a brief of our simple trading plan. Ideally, it should take you no more than 10 minutes a day to manage it once you get the hang of it. This trading plan will work in any time frame, and it'll work in any different market, not just cryptocurrencies and Bitcoin. You can certainly use these combination of trading signals on a day trading strategy, but for the purpose of our trend following approach, we are considering charts using the 12-hour bars. So you can read the 1, 2, 3 pattern in any chart. It doesn't matter if you're trading avocados, you could be trading cryptocurrencies, you could be trading coffee or lumber or silver and gold. All of these charts will have 1, 2, 3 patterns in them. It is a common part of every trend change and every price direction change. That's why this trading system is so powerful and so timeless. So now that we have our trading plan, we can begin to practice for every emergency situation we might face. Just like a pilot would study and prepare before they took their first solo flight. Let's take a quick look at each stage of the trade, and then we'll dig into the details. The first stage of the trade is actually before the trade is executed. This is the stage where we identify chart patterns as they are setting up. That is, our trading signal is almost lining up and it's time to be prepared. The second stage of the trade occurs when the trade is triggered. This is the most important phase of the trade. The approach you use at this stage of the trade can set the stage for your success or your failure in trading. This is the most common place for trading errors and the best place to protect yourself from big losses. The third phase of the trade is a defensive strategy of placing a stop loss just above the new trade entry. The trades that successfully make it past this phase can become our biggest money makers. Now, the fourth phase does not necessarily occur in every trade, but this is where the pro traders have their most profitable trades, and their biggest money makers likely enjoyed the benefits of this stage. The final stage of the trade you may think is exiting the position, and that's true. There's just more after that to get to the success line past the finish line. The greatest difficulty that most traders report is knowing when to take profits and get out of a trade. Has that happened to you in your own trading? Have you stayed in a trade after you shouldn't have and it's gone way down and now you're a bag holder? How much did that cost you? Well, by having this strategy planned in advance and knowing your criteria for closing a profitable trade, for closing a non-profitable trade, you will definitely be ready to capture the profits consistently. And now for stage one, let's dig in. Stage one is identifying potential 1, 2, 3 formations as they're setting up, getting prepared for trades. Most of the time we can see our trading signal coming for days in advance. And during this time we determine what our entry price would be. We estimate what the target profit levels would be. We plan in advance where our emergency stop loss level would be. And finally, we take a screenshot of the chart as we're making our plans. All of this information is recorded in a spreadsheet so that every trade can be reviewed and studied for what was done correctly and for what mistakes were made. Because after you do this, you can categorize your mistakes in trading and they are far easier to correct. Stage 2 happens when the alert is triggered. This is the most important phase of the trade. The approach you use here will set the stage for your success or your failure in trading. This is the most common place for trading errors, and it's the best place to protect yourself from big losses. You know, trading Bitcoin and cryptocurrencies is risky. The markets are thinly traded, they are manipulated, and then they're subject to uncertain changes in government policies and social media and pump and dump groups. And so, in order to deal with this danger, we want to address it in the first few minutes of the trade because it'll have the most important effect on all of our success. Having your risk control strategy prepared in advance has more to do with your success than your entry strategy. So you could flip a coin and be profitable in trading if you have a good risk control strategy. In order to deal with the dangers and the risks of trading, we are going to assume that we are wrong when we are placing a trade, and we are only going to hold trades that prove us correct. Most people start off a trade because they believe they are correct, and then they only exit the trade when the market proves them wrong. This is completely backwards. If you have been making this error, it will be holding you back from greater success in your trading. And let me illustrate why. Imagine if we knew in advance that we were more likely to be wrong when we placed a trade than right. Well, we would never put on our full investment on that bet, would we? Well, of course not. That would ensure that we take the biggest losses. Instead, if we knew that we were more likely to be wrong, we would start off with a small exploratory trade, kind of like dipping your toe in the water to see if it's good for swimming. And if we're not quickly proven correct when we open a new trade, then we reduce or remove the position unless the market proves us correct. Emotionally, it's easy to close this losing trade because we started off with a very small position and because we're expecting it. So our job when we're placing a trade is to protect ourselves against losses. If we practice cutting our losses quickly and only hold the trades that prove us correct, we are dramatically shifting the odds in our favor. When we close a small trade that has not proven us correct, we protect ourselves against the risk of that getting to be a larger loss. The longer you stay in a trade that has not proven you correct, the more likely you are that you are wrong, and the more costly it's going to be. Now, you may say, what about my stop loss? Isn't that what that's there for? I think it's important to consider that the emergency stop loss is like a seatbelt in a car. We never want to use the seatbelt, but we wear it all the time in case of an emergency. It's the same thing with getting out of a trade that doesn't prove us correct. We do not want to wait for the market to prove us wrong and hit our stop loss. We could get out much sooner and only hold the trades that prove us correct. So once the trade has proven us correct, we move on to consider stage 3 of the trade. The third stage of the trade is a defensive strategy of placing a stop loss above the new trade, because our primary job as a trader is don't lose money. In the worst case, we want to keep our losses very small. The trades that successfully make it past this phase, these are the ones that become our money makers. We don't want to hold anything else. Once the trade has successfully made it past stage 2 and prices have gone in our direction, the market has proven us correct and we are profitable, but we are still not out of danger. Our first focus is to move our stop loss above our initial entry to protect our initial investments against fake out breakup moves or reversals. So even if the trade starts out positive right away, we are not out of risk until prices moved high enough to come back and retest levels above our stop loss. So once that protective stop loss is in place, most of our work is finished. The reason we move our stop loss above the entry point as soon as possible is so that we hand over the work to the market. It is not our job to make money, contrary to most people's beliefs. That work we are handing over to our money to make money. We're handing that over to the trade. We're handing that over to the market. We are making our money work for us. That means we have to let the money do the work. The second most common mistake in trading is taking profits too soon. If we've taken a series of losses, we may be overeager to take our profits and prove to ourselves that we are correct. We may become fearful of losing our profits and take our profits to ensure that we don't lose them, only to see the market take off without us and the mass of our profits are just another missed opportunity. It's important that you do not mistake your job for the markets. Your job is to limit your potential losses. That's it. It is the market's job to determine how correct we are. So the market will tell us when to exit. Nonetheless, we must have a very clear and easy criteria that says the market is telling us that the trade is finished. And I'm excited to cover those details very shortly because most traders that I've taught report that taking profit is their greatest difficulty in trading, and I want to address that. But first, a little known stage of trading that most beginners miss and all professional traders use. The fourth phase, adding on to successful trades. This phase does not necessarily occur in every trade, but this is where the most profitable trades will be found. And in the future, your biggest money makers will enjoy this strategy as well. Risk control has two sides to it. At stage 1 and stage 2 and stage 3 of the trade, we are using risk control to protect ourselves against negative risks, with the assumption that we are wrong. But once the trade has approached stage 4, it's now time to increase our exposure to risk because we have been proven correct. You see, fear and greed are natural emotions when you're trading. The successful trader will feel fear and greed as well, but commonly they feel them at opposite times to the unsuccessful trader. Let me explain. The unsuccessful trader will feel greedy when prices are pulling back because they can get a better deal. The unsuccessful trader will hold a losing trade longer, assuming they are correct, until the market proves them wrong. When the unsuccessful trader has a profitable trade, they often feel fearful the market will take away their profits, and so they take their profits too soon. So if you combine bigger losses than needed with smaller profits than possible, trading becomes frustrating and expensive. And this is why 80% of new traders end up failing and losing money. The successful trader also feels fear and greed, but they feel fear when they are holding a loss, fearing that it might get bigger. And when they are correct, they feel greedy and they put on larger trades because they have been proven correct. Over time, the collection of smaller losing trades and the larger winning trades makes a profound difference in the success of your trading. There are two ways to learn any kind of lesson in the world: through experience and through education. So if you stick with trading long enough, eventually you will learn stage number 1 of planning out your trades so that you can identify your successes and failures. And eventually you will learn stage number 2 of only holding positions that prove you correct. And you will also likely develop the skill of putting your stop loss above your entry. And the reason is, the market will teach you these lessons. Because every time you do them wrong, the market will beat you up. It will take money from you. If you stick with trading long enough, you will eventually figure out these basic strategies, or you will have to quit. But stage number 4 will never teach itself to you. You may never know that you're missing out on the best rewards of trading because there's nothing that punishes you for missing these benefits. If your winning trades are the same size as your losing trades, then making money in trading becomes more like running on a treadmill. You don't really get anywhere. So the profound power of adding on to successful trades may not be immediately obvious. And without someone pointing out these benefits to you, without someone having pointed out these benefits to me, and without me considering them carefully, I didn't appreciate the significance of this common habit of successful traders. It really makes a difference. Now, the final stage of the trade, the most difficult stage of the trade, is exiting the position. Many people report this is the most difficult time of the trades for them. Markets are going up, they want to hold it forever, and it tops out and starts coming down. You don't know when to get out. So by having this planned in advance and knowing your criteria for closing a profitable trade, you can be much better prepared for capturing profits consistently. And this is the chart pattern that I want you to get skilled at recognizing. This is a 1, 2, 3 top formation. Prices are almost to break below the exponential moving averages and break the uptrend line. So all of the requirements are right there, and you should be able to grade this chart in a moment when looking at it. If you are having trouble taking profits, one strategy that's important is that you may be doing an all or nothing approach to closing your positions. So rather than scaling out of your position and keeping some of your position open for those bigger potentials, we want to scale out of our position the same way we scale into our position. Start off with that small exploratory bet and then add on to the trade through stage 4. When we're closing the trade, we do it backwards. We take off part of the trade, then we take off the rest of the trade when that confirms. So let's get clear on the exit. This chart pattern should be as easy to recognize as the entry signal. We really should be able to see it coming and be prepared in advance because we're trading on the 12-hour time frame. So taking action on a top formation is similar to a bottom formation entry, but the 3 trading criteria are used in a different order. For the top formation, we plan to exit the trade after the prices have broken over the 1, 2, 3 top formation. Part of our position will be closed when the exponential moving average crosses on the 4-hour time frame. When the exponential moving average crosses on the 12-hour time frame, we close the rest of the position. Very clear and very simple, and it works out so often it's amazing. After the exit. Now you have a complete and practical system that follows a trading situation from start to finish. You have an entire trading plan. You have strategies to manage risk control at the 2 most difficult areas of the trade. And this afternoon, you can go and apply this technical analysis method to any market, from crypto to Forex to equities to commodities. It works in all of them. And today we not only outline the technical analysis for the specific trading plan, but we also provided a practical sequence of stages to help you succeed when the markets are correct. But let's take a moment to reflect. Recall that we agreed at the beginning that technical analysis is a skill that we believe will help us make money. It's a skill that we use every time we place a trade, or we manage a trade, or we close a trade. And so it follows that we want to develop pilot level skills in trading. And you may recall at the beginning of this video, I said that if you skip stage 1, you are sure to fail at trading. And you may be saying, what was stage 1 again? And that's okay, that's normal. We've covered a lot of material here. Repetition is the key. So stage 1, just to review, stage 1 is actually where we do the most work until after the trade is complete. After each trade is complete, we also want to update our spreadsheet again. We want to enter the closing date of the trade and the closing price. We also want to capture a screenshot of the chart at the time. And each time you go through the full trading cycle, it is a chance to pause and study and learn from your own trading. Remember, there's two ways to learn trading lessons: through experience and through education. And they go in a circle, yin yang, education, experience, education, experience. There we go. Technical analysis for the complete beginner. So we went over the simple trading plan and the requirements for getting in and getting out of that. And we went over the 5 stages of a trade. So you know the planning sequence, the putting on the trade sequence, moving your stop loss up, when to add on to a trade, and when to get out of the trade. Fantastic stuff. I hope this has been really helpful for you. I would love to hear your comments. So thank you very much, everybody, for turning up today. I appreciate your audience, and I'm keen to hear your feedback. How has this been helpful for you? Anything that you could tell about what you would like to see added to this, what you think should be included, would be also fantastic feedback. But that about wraps it up, and I'm going to bid you farewell and wish you all the best in the rest of your day and the rest of your week. Thanks again, and bye for now.